What an unbelievably crazy day we had today in the markets. Seems to be getting crazier and crazier, and I think definitively now we can say that the coronavirus, the global pandemic that we have, that the World Health, or those incompetent liars and assholes at the World Health Organization and CDC, finally admitting it's a global pandemic, it definitely has been the pin that has pricked the everything bubble. Global asset markets collapsing, unbelievable. So, let's talk about what the Fed did today. So the Fed attempted a massive new helicopter money drop. They went to what Lynn Alden called, I think, unsterilized QE. Let me get her exact tweet out here. I'm going to be reading some tweets here from some people I respect that had some interesting comments here. So this is from 4 hours ago. Lynn Alden, who I follow on Twitter, very smart lady. Don't agree with her on everything, but her analysis here is good. The Fed will now buy treasuries across the full maturity spectrum, she says full QE, and will do multiple layered 500 billion repo operations, unprecedented massive monetary injection here. Okay, and you also have unbelievably large term limits for the repo. I believe it's 3 months. So she also was talking about why the repo was done so much. So a lot of people seem to think that the Fed is just trying to prop up the S&P 500, but really it's the credit market under the surface that is the larger problem, and what the Fed must be losing sleep over right now. So this is another tweet from her, a huge percentage of companies must be tapping into their revolving credit facilities with banks or plan to do so soon. Airlines, restaurants, hotels, oil, all because of the coronavirus. The coronavirus has collapsed demand for oil, especially in China, but also elsewhere, with travel restrictions, air travel, people voluntarily not wanting to travel, people voluntarily not wanting to go on vacation. So no business trips, no vacation, and banks are not designed to send all that cash out at once, hence massive Fed liquidity injections, among other reasons. So, crazy amounts of stuff. Okay, here's the other tweet I wanted to read from her. So she said, if the dollar spikes enough, several countries would have to sell part of their 6 trillion or 7 trillion in U.S. Treasury holdings to pay their bills. The Fed would then probably need to buy that up if that happens with trillions of new dollars, easing the dollar again. So this goes back to the dollar tug of war. So we're in now this vicious cycle, this really bad vortex loop of doom. We are in the vortex loop. And have you seen a chart of the VIX? So the VIX right now, let me hit the refresh button. The VIX was just below Lehman Brothers levels. VIX was up a lot yesterday. It was up like 30-something% yesterday. It is up another 40% today. The VIX is at 75.47. You really have to see a chart of the VIX now, because the last time the VIX was this high, it was on October 19th, 2008, right around Lehman Brothers at 79.13. And guess what the Dow was at back then? The Dow in 2008, I have up here. The Dow was, okay, in 2000, let's just talk about 2007 and then 2008 with the Dow. So the Dow opened the year at 12,474. And then Dow ended the year in 2007 off its October high at 13,264. At the end of January, the economy started to slow down. March 17th, we had Bear Stearns. The Dow, by May, the Dow rose above 13,000 in spite. In fact, many thought the Bear Stearns rescue would avoid a bear market. By May, the Dow rose above 13,000, so the Dow was still rallying. It seemed the worst was over. In July 2008, the crisis threatened government-sponsored agencies Fannie Mae and Freddie Mac. They required a government bailout. Treasury Department guaranteed an estimated $25 billion of their loans and bought shares of Fannie and Freddie stock. FHA, Federal Housing Authority, guaranteed $300 billion new loans. On July 15th, on July 15th, 2008, the Dow fell to 10,962. It rebounded and remained above 11,000 for the rest of the summer. By September 2008, the month started with chilling news. On Monday, September 15th, 2008, Lehman Brothers declared bankruptcy. The Dow dropped more than 200 points. On Tuesday, September 16th, 2008, Fed announced it was bailing out insurance giant AIG and made an $85 billion loan in in air quotes here that I'm reading, in return for equity effectively taking ownership. And let's see what the Dow was here. Okay. On September 17th, 2008, the Dow fell 449 points. On Thursday, September 18th, markets rebounded more than 400 points. So there's a lot of volatility here. There's rallies. A lot of it was probably central banker intervention, plunge protection team, market manipulation, trying to move the Dow back up. There's attempts. So during the day today, on the announcements of the Fed, and I'll talk more about the exact details of the Fed announcement today, but there was an attempt at a rally, and then the stock markets again sold off. So by the end of the day, in spite of what the Fed's doing, and by the way, the Fed's leaking it out there that they're talking about cutting interest rates to zero. That's no longer effective. So in the past, the Fed was able to keep the stock market juiced by talking about rate cuts, jawboning the stock market, and that would keep the stock market either at certain high levels or move the stock market higher. That is no longer effective. In fact, it seems the Fed's policy announcements today with even larger, stupid... I made a joke about it with Spaceballs. I put like the ludicrous speed, because that's how quickly the Fed's official balance sheet and the repo madness is going to have to grow at this point, because of all the different problems you now have with the global supply chain, with the travel companies. You have all these overly indebted companies that don't need any more debt, but just to survive, these companies are tapping their revolving credit facilities. So these companies already have debt problems, but to survive, so they don't go bankrupt now, and hoping that things recover, 6 months, 12 months, whenever China restarts and the global supply chain restarts and the Europe and the US are through the coronavirus problems, whenever that is. I don't think anyone knows for sure on that. But whenever that does happen, these companies are gambling that either they will, one, get a bailout, or number two, that they can just stay afloat long enough for things to turn around. And that's why they're tapping their revolving credit facilities. If you're not familiar, if you're not a financial professional, don't know what a revolving credit facility is, it's kind of a credit card for a corporation. So you have a revolving credit facility and you pay a certain amount of interest rates. It's like having a fancy credit card in your wallet that you pay an annual fee for. And if you don't draw on it, you still pay a certain amount to have the right to it. And then when you draw on it, you pay a certain amount of interest rates, and it depends how much assets you have, how much cash flow, things like that, how much collateral. The problem is the companies that are drawing on the revolving credit facility are not companies that are in good financial shape. That's the problem. So we're in this now, this vicious cycle, similar to 2008, this doom vortex loop again. Oil is still a mess. We have yesterday the story, another OPEC country, United Arab Emirates, the third largest producer in OPEC, they're increasing oil production too. So this seems a coordinated attack. There's obviously a couple different reasons probably why these countries are increasing oil production, but this definitely seems like a coordinated attack. They're going for the kill shot on shale companies. Crude oil dropped substantially again today. Let me take a look at the... I have so many windows open. I'm just hoping that this doesn't crash the live stream. I think I have about 15 windows, tabs open on my browser. Okay, the oil prices. Crude is down 4%. Brent crude's down almost 7%. It's not helping the oil companies. The banks, so the Midwest banks, the smaller and medium-sized Midwestern banks that have a overly large percentage of their loan book to oil and natural gas companies, the southern U.S. companies, that the small and medium-sized banks that have an overly large percentage of their loan book to oil and natural gas companies, those banks are getting killed right now. In fact, they may already be failing. We may not know about this for a while. And then the question is, who are those banks' counterparties? So if the energy companies go down and they default on loans, then those banks are in trouble. And if those banks go down, now we're back into the 2008 conversations where counterparty risk matters. And one of the reasons why gold is down and gold stocks are down so much is there's a lot of stories. They're all over Twitter. Simon Mikhailovich, time financial professional, he was posting on his Twitter earlier today. I don't have the tweet up to read it, but about the margin calls that a lot of professional traders, professional investors, hedge fund managers are getting. So they have all these losing trades, all these losing investments, and they're selling their gold. They're selling their best gold stocks for cash because of the margin calls. So that's what seems one of the main reasons why some of the best gold stocks, the baby is being thrown out with the bathwater. You have these really quality companies that are just getting overly punished because, I mean, the margins for a lot of these gold miners, as long as there's not coronavirus at the mine or in the local town, these gold miners are going to mint money now. For the first quarter 2020, with oil prices where they are and gold prices still high, the margins may in fact end up being better than 2011. That's how good the margins are for some of these gold miners. Because remember, I talked about this yesterday, the cost for the gold miners rose ridiculously fast in 2010 and 11. The cost for all the mining equipment and oil, it was rising. At one point in 2011, the costs for mining were rising faster than metals prices were. Okay, I didn't finish up what the Dow got down to. So the October 2008, the Congress finally passed the bailout bill in early October. The Dow dropped 800 points in spite of that, closing below 10,000 for the first time since 2004. The Fed tried to prop up banks by lending $540 billion to money market funds. The funds needed the cash to meet a continuing barrage of redemptions. Since August 2008, about $500 billion have been withdrawn from money markets. JP Morgan managed the Fed's money market investor funding facility, purchased $600 billion of certificates of deposit. Let me see here what it says about the Dow. Okay, the money began, the month of November 2008 began with more bad news. Labor Department reported the economy had lost a staggering 240,000 jobs in October. AIG bailout grew to $150 billion. The big three automakers asked for a bailout by November 20th, 2008. The Dow had plummeted to 7,552, a new low, but the stock market crash of 2008 was not over yet. By December 2008, the Fed dropped the Fed funds rate to zero. That's where probably we're heading back to sooner than people think. Its lowest level in history. The Dow ended the year at a sickening 8,776 or 8,776.39, down almost 34% for the year. So we are in an official bear market, and just in the last 3 weeks, we are down more than 30% in major U.S. stocks, an enormous tumble. So yesterday we were down more than 20%. Today another hammering with stocks down. Let's see here, Dow's down just under 10% at the close, 9.99%. NASDAQ down minus 9.43%. Russell 2000, which is small caps, is down even more than that. Silver, oh my God, silver is in trouble again. The silver miners, if oil prices were higher, the silver miners would be looking at bankruptcy. If silver goes lower, the silver miners, some of them are going to be in trouble again. If silver breaks 15, some of these silver miners might not make it. It depends how low silver would go and how long it would stay there. Now, some of these silver miners have done a good job over the last 2 or 3 years, cutting costs to the bone, improving their balance sheets, but there's really not a lot more costs they can cut. And there's not a lot of capital available for the miners. So if you're holding some of these silver miners, you're going to have to pay attention to this more than you would want to. You're going to have to look at if these silver miners draw on their revolving credit facilities and when their debt's due, things like that. Okay, Lawrence Lepard, LEPARD, he's a gold fund manager. He says that the Fed has done a combined $4 trillion injection. So New York Fed buying $1.5 trillion this week via repo. New York Fed buying another $1 trillion of securities per week for the rest of the month via repo operation. $500 billion, 1 month repo, $1 trillion for 3 months. And then Brad Houston, Huston, was looking through the numbers, and I think he said $1.5 trillion this week. His estimates are different than $1 trillion for the next 4 weeks, $5.5 trillion total, according to him. So the Fed is putting in trillions and trillions of dollars into the system, and the markets are not responding positively. This is very similar to what happened in 2008, which means to me, there's counterparty. People are worried now about counterparties. People are worried about default. People are worried about derivatives. That's what it means to me. At some point, the Fed will regain control. I don't know how much they're going to have to print to do that. No one knows. But we are going to be in an increasingly likely scenario where the rules are going to be changing constantly. If you think the rules changes were bad for the last couple years, just wait until what happens in the next couple months with governments and central banks. All the rules changes. If stocks keep going down, maybe they ban short selling. Who knows? Most people forget this, but a lot of regular profitable short trades from the large Wall Street investment banks, so people who were using Goldman Sachs and others as their clearinghouse for shorts for banks and financial stocks, their profitable short trades were canceled in 2008. Not everyone, but a good amount of them were. My friend who's hedge fund manager, Kevin Duffy, a Baring Asset Management professional trader for 30 years, I've talked to him about this story, and him and Bill Wagner, who was his hedge fund manager partner at the time, they had bought puts, so they were not affected. But the people who were short, who had millions of dollars in profitable short trades, their trades were canceled, were wiped away. Their profits were eliminated. This is how dangerous things are in this environment. Governments can change the rules. They can ban short selling. They could tell the stock brokerages or the investment banks to cancel trades. They could deem companies like Boeing national security. They could deem oil companies national security. The oil companies could be claimed for national security purposes. This might happen, actually. So instead of a normal bailout, the oil companies might be labeled national security purposes, and then who knows how they figure out how to bail them out. We're in a crazy twilight zone here. If you're new to the channel, I try to talk about how this is dystopian, this is bizarro world, this is a Black Mirror episode. This is the twilight zone. There's nothing fair about what's happening right now, and the rules could change constantly. Which means that if you have a profitable short trade in your account, this is hypothetical. If you have a bunch of profitable short trades in your account right now, and you're making a lot of money shorting Disney or Boeing or the hotels and casino stocks or the airlines. By the way, American Airlines. There's rumors going around a lot that American Airlines could be bankrupt within weeks. So we'll see what the Federal Reserve decides to do there. You know, you could have a very profitable short trade on some of these companies, and all of a sudden the short trades, the investment banks or stock brokerages could be told by the government that your short trades are canceled. So people are asking me like what they should do, and I'm like, you're gonna have to pay attention every day to the rules changes. So if you're up a lot in your trading accounts and you go away for a couple days or a week and you're not paying attention, the rules could completely change. You come back and your trades are canceled. This sucks. It's not fair. This is what governments can do. And the odds of rules changes are only going to increase the worse things get. And the main reason is because I would say the Treasury has lost hundreds of billions of dollars in capital gains tax revenues with the stocks falling. So this stock market crash of over 30%, well, around 30%, the U.S. Treasury has already lost many hundreds of billions in capital gains tax revenues. Do you think they're worried? Do you think they're upset? That means the Fed has to print all that extra money. If I was running the Treasury, I'd be upset about that. I'd be very worried if my budget just had a big hole in it. So the Fed will do increasingly larger, increasingly more stupid things to try to move the asset prices back up. Because if the asset prices don't go back up, everything's going to look even more insolvent than it was before asset prices started crashing. Which increases the probability then. I think the timeline for $2,000 an ounce gold has moved up. Yes, the gold price is down in the short term. A lot of it's margin calls. So a lot of the best gold stocks like Sandstorm Gold and others, unfairly punished, they're going to make a lot of money. As long as there's not coronavirus at the mines. You never know with these things. But, you know, if there's not coronavirus at a lot of the mines, these companies are going to make a lot of money because of their margins and how much of the input costs are based on oil and energy. But the timeline, what the central banks are going to do. Oh, and I wanted to talk about because today is Thursday after all. We got a Fed's official balance sheet update. So I know I'm ranting, but there's a method to my madness here. Fed's official balance sheet update out today since it's Thursday. Okay, in 1 week, the Fed's balance sheet is up another $70 billion officially. Up $70,404 million. So since the end of August 2019, which is when quantitative tightening or balance sheet reduction ended, remember, it ended prematurely, the Fed's official balance sheet is up now $551,965 million. And you know what? It's just getting started. The increases are just getting started. Okay, central bankers collectively, according to hedge fund manager Tavi Costa, I showed the chart in another one of my short videos earlier this week. They threw $625 billion in only about 20 days into all these asset markets, and the market still crashed. So, like the largest 5 or 6 central banks on the planet threw $625 billion. The Fed threw $80 billion last week. So the Fed put $80 billion approximately last week, another $70 billion this week, into the markets, and the market still crashed. And this is why you have President Trump, talking about a $300 billion payroll tax cut, which the Democrats I don't think will allow. But Bloomberg Radio last night, I was listening to Bloomberg Radio for about 20 minutes or so at the gym while I was working out, and the talking heads, the radio announcers from Bloomberg Radio, you could tell how jittery they were, but they were optimistic and didn't care if it was inflationary, if the U.S. Treasury and the Fed just literally printed money and handed it to American workers. So salaried employees like servers who were staying home because they were maybe sick or had some symptoms, or they were worried about going to work and getting infected with the coronavirus, and they were excited about the possibility of the U.S. Treasury and the Fed sending checks to workers to spend into the economy. So this is part of the rules changes. This is dystopian. So you think that the asset prices are going to keep collapsing. You have all these profitable short trades, and here are the people at the Treasury, the people at the Fed, the people at the Trump administration scheming behind your back to stop you. Who's going to win? In the short term, I think the asset prices are going down. Eventually, the elites will come up with a new scheme. Right now, the helicopter money drops are not working. Which normally the people in power, if something like that's not working, they just do bigger. Jonathan asks, how is a tax cut going to help the Treasury shortfall? It won't. The Fed would have to monetize even more debt. The Trump tax cuts actually increased U.S. Treasury tax revenues. The problem was government spending increased faster. The U.S. budget deficit increased faster and grew faster than the increased tax revenues that came in from the Trump tax cuts. That was the problem. So government's already too big and spending too much that tax cuts will not provide as much of a benefit as they would in the past when government was smaller and debt to GDP ratios were lower. At the current pace, the Fed is going to be, the Fed's official balance sheet will be larger than 2008 levels in probably less than 3 months, it looks like. What, it was $4.5 trillion? The Fed's official balance sheet in 2008, didn't it get to $4.5 trillion, or was it $5 trillion? I think it was $4.5 trillion. It's going to have to go way larger than that. Like in Spaceballs, remember the movie Spaceballs? There was like there was all those things on the dashboard there with Darth Helmet, and there was like ridiculous speed, and then there was ludicrous speed. The Fed's balance sheet is going to have to go, and the repo madness are going to have to go to ludicrous speed. Well, when no one is working, people aren't consuming, and all those travel industry, consumer companies, their restaurants, they're going to be screwed. People don't have discretionary income then. IBJI says Disney just closed their theme parks. Makes a lot of sense because a lot of people weren't going to their theme parks anyway. Who's going to get on a plane and go to Disneyland or Disney World now? Also, I believe there was an infected employee at Paris Disneyland, and he got a lot of people infected. And Tokyo Disneyland was already closed, I think, a while ago. Okay, got a bunch of super chats. Let me take a look at the super chats now. You really have to take... I will put out a short video on this. I'll take a screenshot of the charts. You really have to see the VIX spiking. We are just below Lehman Brothers levels. And the Dow right now is still... The Dow is still way above what it was in 2008. So yes, central banks have created a lot more in their balance sheets. Now, history doesn't exactly repeat. But if you use the VIX as an indicator, the VIX is saying that the stock markets are going way lower. Which means that the manipulators in power, it's time to whack down the VIX. I don't know if they're going to be able to at this point. Because remember, the higher the VIX goes, the more likely things are going to blow up with the leverage short volatility trade. So there's going to be some idiot hedge fund managers that didn't actually hedge, that were unbelievably short vol. There's been pension funds that have been shorting vol. Those pension funds are going to need bailouts too. What a mess. Okay, here's more details. Before I go to Super Chats, let me just talk more about the Fed's programs today. Bazooka fired, Fed unleashes 1.5 trillion repo bailout, expands not QE to QE5 after increases in its repo facility twice already this week from 100 billion to 150 billion to 175 billion overnight, and adding a new 1-month term repo facility. Again, the term repos are key because whoever borrows from the term repo has control of the capital for longer periods of time, which means that's longer periods of time they don't have to declare being bankrupt or insolvent. Added a new 1-month term repo facility, and that's longer that they could buy time until a recovery when asset prices go up, or the Chinese economy restarts, or there's some improvements with the global supply chain. 1-month term repo facility, the New York Fed just stunned the market and fired its biggest bazooka since Lehman Brothers, not coincidentally just moments before today's 30-year Treasury auction, as a failed auction would mean well game over, by announcing a total of $1 trillion in 3-month repos. See, I can't remember there being 3-month repos before this. I think this is new. I think the 3-month repos are new because I think the Fed was told how bad the problems are that these banks and other entities have to have access to the repo money for 3 months. And what they can do, and this is a play on what Kyle Bass has said with the Chinese government, how a rolling loan gathers no loss in China. Well, I've said this now since Repo Madness started in mid-September 2019, and then took a break for a couple months from the first week of January until the last week or two, is that a perpetually rolled over term repo gathers no loss. And the repo now is the new bailout facility because why? The Fed can just say it's only temporary. The Fed can say, well, we're not adding repo to our balance sheet, it's only temporary. And you know what? Most financial professionals in their $5,000 suits and stuffy shirts and who waste 3 hours waiting in the TV or more in the TV waiting room to go on Bloomberg or CNBC for 5 minutes or less to promote their fund that's losing massive amounts of money, they will believe the Fed. It's hopium. Okay, back to the article about the bazookas. Okay, 3-month term repos over 2 days, 500 billion today, 500 billion tomorrow. That is insane. You know things are bad if they're issuing enormous amounts of term repos that are 3 months long in back-to-back days. 500 billion a pop. And watch this, maybe they do more tomorrow. As well as an additional 500 billion in 1-month repos offered weekly, which means up to 3 trillion in cumulative repos if fully allotted, maybe online by the end of the month. But wait, there's more, because the Fed also officially threw in the towel on the semantics BS bullshit it was pulling since September 2019 by pretending that QE is not QE when it officially expanded not QE, QE4 to QE5. Yeah, there was a definition change on what is QE, the old Ben Bernanke definition. I've talked about this for a while. The people inside the Fed recently, since October, when not QE was announced at $60 billion per month, and the former Federal Reserve people and the Keynesian academics at universities and the Wall Street Keynesian economists were all saying that it's not QE because the definition had changed. Again, this is the problem with moving the goalposts. The average person doesn't understand any of this. It's confusion and obfuscation. And now my dad's depressed because his retirement account collapsed. I warned him, he didn't listen. I'm sure there's a lot of people in the same boat with him. A lot of baby boomers and retirees. Okay, but wait, there's more, because the Fed also threw in the towel on the semantics bullshit it was pulling since September 2019, not QE, to QE5 when it announced it would. I reread that, my bad. When it announced it would start purchasing coupon treasuries as part of its permanent open market operations, or POMO, which, as a reminder, was the official trigger transforming not QE into QE. For some context of how that compares to what they've been doing, assuming the full allotment of the repos, this chart is insane. You can see part of it there on your... Yeah, you can see the whole thing there on your screen. Welcome to Dystopia. And you know what? This is the problem with fiat currencies. If this doesn't work, the Fed will just change the rules and do even more. Or ban short selling. Or God knows what else they can do. Jack says, when will the people get the money? It sounds like people may start getting checks. So if people are hourly workers, they may get checks to not go into work. Also in Italy, did you guys hear in Italy that mortgage payments for at least a month or two have been suspended in Italy? So I would not be surprised if things get bad enough here in the US to prevent housing prices from collapsing if the US does that too. They could change the rules however they want. This is the power of big government. Especially the US empire. The most pressing problem, I think, is the large corporations that are drawing on their revolving credit facilities, and the banks now are stressed dealing with that. And then the banks also have to deal with all the counterparty risk for the bad oil loans and the oil derivatives. The oil derivatives are definitely going bad. There's no way that many derivatives are really hedged. And the oil price got halved in 2 months. Thank you for the super chat, Greg. I appreciate it. Thank you for the super chat, JB Weld. He asked, do I think this bailout will be highly inflationary, and would it follow that stocks would be a great hedge to it? So, normally with these types of things, the stock market for a while goes up a lot. And that is good for the US Treasury. That means more capital gains tax revenue. So the hundreds of billions of dollars the Treasury just lost in 2020 capital gains tax revenues, 2020 capital gains tax revenues would go back up. However, at some point, inflationary expectations could increase, velocity of money could increase, maybe the Fed overdoes it, maybe foreigners start to dump the dollar, we don't know. Right now, foreigners need dollars more than they want to dump them. Foreigners need dollars so they don't collapse first. Go and watch my JB, if you haven't seen already, go and watch from the first week of January. I put out my dollar tug of war. It's like 6 minutes long. So it's complicated what's going on with the dollar. I'm dollar neutral, at least for the short term. So the dollar has two very strong forces pulling on it. The Federal Reserve, the US Treasury, President Trump administration all want a weaker dollar, and they're willing to do almost anything to stop it. But the demand for dollars outside the US is enormously large. There's $24 trillion at least in dollar liabilities, and those people need dollars so they don't go bankrupt. So those two countervailing forces are in a very powerful tug-of-war pulling on each other, and that's why the dollar has not collapsed, and that's why anytime the dollar looks like it's about to rally even more, it gets weak again. Because the U.S. government, U.S. Treasury, Federal Reserve do not want the dollar getting too strong. Thank you for the super chat, Dimitri. I explained that. So it's combination of margin calls and extreme risk off. So there are professional money managers that only want cash or dollars, mostly dollars probably. So cash, U.S. Treasuries, although Treasuries might not be as safe as people think they are if you listen to what Jeff Gundlach has been saying lately. And the U.S. Treasury is going to have to issue more. But in extreme risk off scenario, which is what I've called it, people go to maybe cash, Treasuries, gold exposure that is not gold stocks, so maybe like physical gold, GLD, Sprott Physical Gold Trust, Central Fund of Canada. They don't own a lot of stocks. Maybe they have some defensive stocks like Costco or Clorox. The lines at Costco are insane. I've been hearing stories from friends about the lines at Costco. They are nuts. Costco must be minting money right now. Well, if they have items in. I'm hearing stories from friends all over the U.S. and watching video and articles about the lines at Costco. They're insane. Clorox, with the wipes and the bleach they're selling. I don't think Lysol or Purell are publicly traded, but those goods are gone from the shelves. So if they were publicly traded, those companies would be minting money right now. So defensive stocks, maybe if anyone's going to own any stocks at all. And then a lot of professional money managers are shorting. So this is what people don't understand if you're not familiar with markets, if you're new to markets. Once stocks start going down, it becomes a trend. And then the trend just starts feeding on itself. So you have all these high-frequency trading algorithms. Once stocks start going down, they have really high pattern recognition. They do this by algorithms. So they notice that prices are falling, and they all pile into whatever's falling in a trend. And then you have professional money managers who are either trading by program or doing it manually, noticing these trends too. And so they're piling in. And so this becomes a vicious cycle. And this is what is happening with gold stocks. Even the best gold stocks are being victims to shorts. This is what happens in a bear market. In a bear market, even the best stocks like Sandstorm Gold and some of the other great stocks, they even sell off too. Just for the short term though, because eventually, like I said, at some point, the Fed will figure out the right formula for moving the stock market higher. Maybe that's banning short selling and expanding the balance sheet by $1 trillion a month. I don't know. That's an educated guess. I think at some point the Fed probably will. If things are as bad as I think they are with the energy market and oil derivatives and all these corporations now that are tapping their revolving credit facilities and the global supply chain breaking and the Chinese economy is much worse than the Chinese government claims, I think the Fed's probably going to have to go hundreds of billions per month, increasing balance sheet, maybe even $1 trillion per month. I don't know when that's going to happen, but the Fed is going to keep playing around with the right formula to move the stock market higher. The Fed cares more about the credit markets right now. So they want to make sure the U.S. Treasury has all the funding they need at the lowest interest rates possible and the credit markets. So the credit markets are what's causing the stock market to go down more than fundamentally, more than anything else. But then you have the high-frequency trading algorithms and the trend traders that notice the stocks are already going down and then they just pile onto it and make it worse. At some point, this will reverse when the Fed figures out the right formula, which is the right formula for moving the stock market higher. But that's not going to be rate cuts. It's going to be how much repo madness or how much balance sheet expansion. I would not be surprised in the next month or two to see the Fed announce increases of their balance sheets over $150 billion a month, maybe a couple $100 billion. And then at some point, maybe if that doesn't work, they'll do even dumber than that. Because right now the Treasury is going to have a big hole in the budget, and then the Fed's going to have to cover it even more. Yeah, people are asking me what price target should they buy Sandstorm Gold stock at, or what price target should they buy this gold stock at. The truth is we don't know how much lower this is going to go. So this is why, and I've repeated this nonstop, you do not buy all of your stock positions at once. You buy a little bit maybe, and you wait just in case it goes down. This is what happens in a bear market. Things go a lot lower than you expect. You have quality companies that are worth unbelievably more than the share price, and they just keep getting cheaper and cheaper and cheaper. But you need cash to buy the bargains. And this is why you don't buy all of your stock position at once. By far the most common mistake I've heard is people do some research, they like a stock, They read a newsletter, and then they buy all of their share position at once. It's not very smart. You're trying to perfectly time the market. If you buy all of your stock position at once, you are by definition trying to perfectly time the market, which is a fool's errand. Mark says silver and gold will be the last dogs standing. I think we're going to see the timeline has accelerated now for $2,000 an ounce gold. So yes, gold has gone down in the short term, and there's margin call selling and there's shorting. However, I think things are so bad, and the central banks will have to do so much crazy nonsense that the timeline for $2,000 an ounce gold is accelerated. It probably moved up just in the last couple weeks. It probably moved up the timeline to $2,000 an ounce gold at least a year. Because to counter all the asset prices falling, the central banks are going to have to do even crazier, even dumber things. PEH asks, how long before rates are at zero? Danielle DiMartino Booth and Jeff Gunlock had an interesting call last week. It's in the Wall Street for Main Street Facebook group, also on Danielle DiMartino Booth and Jeff Gunlock's YouTube channel. So I would recommend listening to that. They think that the rates could be at zero in the next couple weeks. So in the short term, gold may go lower, but the central bank response will be even larger, which will ultimately force gold higher. I still know a lot of professional money managers, people who are not gold bugs, who are buying gold on dips now. So they buy a little bit more gold, the lower it goes. And a lot of the people who sold gold did not voluntarily do so. They had margin calls. If you're not familiar with what a margin call means, if you're new to finance or new to this channel, what a margin call means is you have a bunch of bad stock trades or commodities trades or currency trades, and you have to sell other assets you want to raise cash to close out the position, or you might owe more than you risked with a margin trade. So you have professional money managers and other high net worth people that are getting tons and tons of margin calls. Simon Mikhailovich talked about this on his Twitter today. And so those people, they don't want to sell gold, but they have to sell gold. And this is very similar to what happened in 2008. So initially, if you weren't around in 2008, I'll just briefly recap it. What happened in 2008 is initially, I think the gold price was above 1,000, and for quite a few months, the gold price dropped to right below 800, and then within about 18 months, it was at 1,900. So it was incredibly volatile. It was a roller coaster ride. Gold initially dropped a lot. People were questioning, why is gold falling? And the answer was it was margin calls. People didn't want to sell gold. They were forced to sell it because they were looking at bad trades, bad investments, potential insolvency or bankruptcy if they didn't raise cash to cover their other losses on trades. And then 18 months later, gold was up a lot higher before they manipulated gold back down in September 2011. And then the paper bear market started. Same thing with silver. And some of those gold mining stocks that had crashed, I was buying those for pennies on the dollar in 2008-9. I was not buying all my share positions at once. I was buying $100 a share here, $100 a share. I was buying 100 shares here, 100 shares there, and accumulating positions, seeing if it would go lower. And within about 18 months, I had profits on a lot of those gold stocks because I did a pretty good job picking out most of them. I had 400% to 600% profits on those gold stocks before I sold out. Now, if you bought and hold those gold stocks, the roller coaster ride, the volatility was incredible, and some people might not have been able to handle it. If you timed this right, you made enormous amounts of money in only about 18 months. But you had to have cash, and you had to have discipline to pull the strategy off. Thank you for the super chat. I agree with you about Epstein. I won't say anymore. Probably because I mentioned his name, the video will be demonetized. Okay, another super chat from Acrobat Mapping. Is Vanguard money market safe? Is it is supposedly backed by government. That's where my cash is in Vanguard Fund. So you're not really getting anything in Vanguard. What you have to look at, Acrobat mapping, you either have to contact investor relations at Vanguard, or you have to look at where your money market fund is loading the money. If they're loaning the money into the repo market, and one of those large brokerage houses, I can't remember if it was Fidelity or Charles Schwab or Vanguard. Maybe it's all three, but one of those, at least one of those large brokerages, because one of my Patreon account contributors, on my almost 500 now, Patreon account contributors chipping in at $500, not $500, I'd be rich if it was $500, $5 a month or more, sent me an email with what his money market fund was investing in. And I think like 30% of his money market fund's capital was invested in the repo market. So big red flags. Because hedge funds and investment banks and primary dealers use the repo funds for all kinds of craziness, especially hedge funds. Because hedge funds have been doing really dumb trades, leveraging up treasury bets 10x or more for the last couple years. So I'm not giving you a full answer, but I'm telling you, you have to go do your homework and you have to find out. You have to either contact investor relations or it might be on their website. They're probably required to disclose it in their prospectus and update it at least once a year where those money market funds are being loaned to. There's a lot of, Rand says time for a Wall Street for Main Street Patreon account contributor. Great. There's a lot of content behind there. There's articles, audio, podcasts, some chart work. I might sound like Ben Shapiro, but I can promise you I don't look like him. Ben Shapiro, I have like 50 or 60 pounds more muscle than Ben Shapiro, and I'm a lot taller than him. Ben Shapiro doesn't know he can't even spell weight room. Plus, I'm not. If I was Ben Shapiro's wrong all the time. I think he's paid to be wrong, though. I think he's paid by like the Israeli government and the military-industrial complex to be wrong. Actually, for gold mining stock analysis, I was supposed to have Nolan Watson on for a podcast interview today. The interview was booked and it had to get rescheduled. I can't say anything more than that except that it sounds like there might be some good news soon. It had to get canceled last minute. So, sounds like there was some emergency negotiations, maybe another miner's going bankrupt or something, and there's a gold or streaming deal available that was not available before, something like that maybe. I will try to get it rescheduled. Again, I was supposed to have 2 really good interviews scheduled for this week, and they both canceled last minute. I am trying. Okay, well, that's it for this live stream show. I want to thank everyone for listening. And thank you very much to my almost 500 now Patreon account contributors. It is growing very rapidly, a couple per day. Sometimes more than that. Sometimes 10 a day. At chipping in at $5 a month. So I can focus on my unique research ninja skills. Okay, bye everyone for now.